Hello and welcome to this class on bank runs and the panic of 1907. We will proceed in two steps. First, we will understand what a bank run is and why banks are prone to runs. We will then consider our first major case study, the panic of 1907. This is one of the most prominent financial crises in US history. It was a massive banking panic. It led to the formation of the modern Federal Reserve System. We will understand why the panic happened and how it was resolved. Understanding these historical episodes can be enjoyable and highly informative. Please don't worry about the precise historical details. I will mention many details, but these are mostly for fun. Focus on the narrative and what we can learn. Let's get started. Why are banks susceptible to runs? Well, banks borrow short-term by taking deposits and lend long-term. This creates a maturity mismatch between assets, the loans, and the liabilities, the deposits. This maturity transformation is a key feature of the bank's business model. So, why might a run occur? Remember that depositors can withdraw their funds at any time. If some shock or bad news arrives, this presents a risk to depositors. They might decide, play it safe and withdraw, perhaps because they see people waiting in line in front of a bank. It is usually rational to join a bank run. If the saver joins the queue, then there is a chance that they get their money back. First in line will usually get paid. If they do not join the run, then they might lose out. Last in line might get nothing. What are the consequences of bank runs? When many depositors arrive at the same time, the bank may not have enough cash on hand. Most deposits are tied up in long-term investments. This is how maturity transformation works. In this case, the bank would be illiquid. It has run out of cash. A bank being illiquid is different from a bank being insolvent. An illiquid bank lacks cash, but its investments could still be profitable. An illiquid bank still has a viable business. It can still be solvent. On the other hand, an insolvent bank has run out of equity. It is bankrupt. The worst-case scenario occurs when solvent banks fail due to runs. This can happen when banks are forced to sell assets with large discounts to meet depositor withdrawals. In our case studies, we will see how this dynamic plays out in practice. We will then see why various financial regulations and government institutions exist to prevent this worst-case scenario. Let's now examine our case study, the Panic of 1907. The Panic of 1907 is a helpful episode to learn about bank runs. At the time, two features of the modern financial system were missing. First, there was no central bank. This means banks had no access to government-backed emergency loans. And second, there was no deposit insurance. Without deposit insurance, depositors were much more panicky. They could lose their life savings if the bank failed. This historical episode helps us to understand what might happen without the modern government interventions designed to prevent bank runs. Let's have a look how this financial crisis unfolded. Like most crises, there was not a single cause but a build-up of bad news that led to bank runs. The story starts with the San Francisco earthquake of 1906, which caused damages of about 1.5% of GDP. Such a large shock immediately rippled through the financial system. Insurers had to sell assets to meet insurance claims. Depositors withdrew money from banks, and stock markets in New York and London dropped. This trend continued. Over a series of days in March 1907, stocks declined by over 10%. Money markets were stressed with interest rates shooting up from 2.5% to over 10% on several days. This event has been referred to as the silent crash because it did not happen in a single day but over several days. The second shock was the 1907 crop harvest. It was not as rich as the previous year, reducing exports. The US Treasury, unable to refinance maturing bonds, withdrew $30 million from banks. With the government and depositors withdrawing more money from banks, the money supply contracted, credit became scarce, and interest rates further increased. In short, financial conditions worsened substantially during the summer of 1907. Against this backdrop, there was one more crucial factor: speculators making risky bets in the stock market financed with short-term bank loans. When these risky bets blew up, the bank loans defaulted, and this started the banking panic. This is the short version of the story. Here's the longer version, which you may find fascinating. The Heinze brothers were very wealthy copper miners. In 1907, they moved to New York City and joined forces with Charles W. Morse to speculate in the copper equity market. They bought a large number of shares of the United Copper Company. They used these stocks as collateral for their transaction with as many as 20 banking houses. The Heinze brothers and their colleagues were speculators making risky bets on the stock market financed with short-term bank loans. On October 9, 1907, Otto Heinze decided to analyze the trading behavior in the United Copper stock. He discovered that about 450,000 shares of this stock were traded, even so, according to the company, only 425,000 shares were outstanding. That meant that some brokers had lent their stocks to investors who shorted the stock. This means these other investors borrowed the stock and sold it in the hope to buy it back at a cheaper price later and thereby make a profit. The Heinze brothers believed that the brokers had lent out the shares that they owned and had pledged as collateral. They reasoned that by calling in the shares, they could create a situation in which the short sellers would be forced to buy the shares they owned at a very high price. This is called a short squeeze. To induce the short squeeze, the Heinze brothers had to borrow $1.5 million to pay off the loans collateralized with the stocks. When the United Copper stock dropped again from $45.50 to $37.75, the brothers started calling in the shares by requesting to pay off their loans. Within hours, the stock rose by $23, but then declined to about $52. However, the brothers had miscalculated. All 20 banks that had extended the brothers' loans backed by the stocks delivered all of the stocks. As a result, the brothers were not able to meet all of the required loan payments and refused to accept the delivery of the stock. The lenders immediately sold off the rejected collateral and the stock price tumbled. After 3 days, the United Copper stock had lost 50% of its value and eventually traded at $10 per share. The short squeeze scheme had failed miserably. The Heinze brothers were bankrupt. On October 16, their brokerage firm closed. So did a small bank owned by one of the Heinze brothers. That small bank, however, used the New York-based Mercantile Bank for payment services and had deposits worth about $1 million. The Mercantile Bank also had direct exposure to the United Copper stock that had collapsed in value. These events were so alarming that people began pulling their money from any bank associated with the Heinze brothers. The panic began. To coordinate an orderly settlement of all claims, the New York Clearing House, a consortium of New York banks, stepped in on October 20th. This was a private sector intervention designed to calm the banking panic. However, during the clearinghouse meetings, the Knickerbocker Trust, which was the third largest bank in New York, was implicated in financial irregularities due to their association with the Heinze brothers. This signaled that the Knickerbocker Trust was in serious trouble. It is not clear that the Knickerbocker Trust was financially unsound, but banks rely on trust. If depositors question whether they will get their money back, they simply will withdraw. And so, on the morning of October 22nd, 1907, a line started forming in front of the Knickerbocker Trust office an hour before they opened. The line seems to grow by the minute, with all depositors demanding their money back. The police were called to help with the line formation. By midday, Knickerbocker announced that it had assets worth about $69 million and liabilities of only $64 million and could pay out everyone. No one dropped out of line. Knickerbocker lost $8 million of deposits that day. This is an example of a classic bank run. Knickerbocker was financially sound, but worried depositors demanded their money back anyway. The next day, Knickerbocker ceased operations. However, many other healthy banks in New York were swept up in the panic. By October 24, 1907, several banks had failed. When runs on the Trust Company of America started, New York's most famous banker, J.P. Morgan, and others stepped in. They provided cash loans to meet depositor demands. The lack of cash pushed the New York Stock Exchange to the brink of collapse. Once again, J.P. Morgan intervened, raising the capital needed to keep the stock exchange in business. With more banks on the brink of collapse, J.P. Morgan summoned about 120 New York bank presidents to his home in New York in early November. He demanded that they help solve the crisis. To force a solution, he famously locked the banker into his library. Eventually, the bankers agreed, and J.P. Morgan contributed another $25 million to resolve the crisis. This good news stopped the banking panic, but plenty of the damage was already done. It was too late to prevent bank failures and too late to stop a severe recession. Let's wrap up. The Panic of 1907 is viewed as one of the most severe financial crises in US history. What can we learn from this episode? First, depositors panicked because they were worried about losing their savings. A lack of trust and cash can lead to depositors' panic. This explains why deposit insurance prevents bank runs. Insured depositors will be protected from any potential losses. This is probably why classical bank runs with depositors lining up around the block are rare nowadays. The second lesson is that cash loans can help stop bank runs that are in progress by meeting depositor demands. In the Panic of 1907, J.P. Morgan acted as a lender of last resort. In 1907, we were fortunate that J.P. Morgan did not run out of cash or face any trouble at his own bank. Without government backing, the option of private lenders of last resorts are limited. This explains why the Federal Reserve, with its unlimited resources, can be more effective as a lender of last resort.